Hi, this is LC. In this video, I'd like to quickly discuss the idea of moving your stop loss level. A lot of times traders will develop some kind of trading strategy, and in the very beginning, I believe that it's really important to do everything you can to follow your trading strategies, your rules, your disciplines. It's really important. So you have to have some structure, you have to have some discipline, you have to have rules. But at the same time, you have to prepare yourself for the fact that price and the markets are not going to react the way you want them to. So prepare yourself for the times that the market isn't going to work the way you anticipate it to, and you've got to create a little bit of flexibility. Now, where do you allow for flexibility? Well, first of all, I'd like to say that stop loss levels are a very confusing component to trading for a lot of traders. Many times you'll go to a blog or you'll go into a chat room and you'll listen to a mentor or you'll read in a book, just as I did at the beginning of my trading career, and you'll hear that, or you'll read that people suggest not risking any more than a certain number of pips on a trade, on a stop loss. So, for example, one of the stop loss levels that I used to hear over and over again in the beginning of my trading career was, don't use or don't risk more than 50 pips on any trade. Well, that's a good idea, sounds nice, but the market isn't always going to move the way we expect it to. And we have to prepare ourselves for those opportunities. For example, if you're going to trade economic data, well, we all know that there's a possibility that, first of all, your broker won't fill it at the right place, the spreads will widen, changing the complete profitability, the outcome of the trade anyway. And even if those two things don't happen, there's always the possibility that everybody else and all the traders are going to react to the data, especially if it's a surprise, in such a wild manner that we can see spikes going 50, 60, 70 pips, maybe even 90 pips in one direction, and then back down just the same length in the opposite direction, all within a few minutes. And if you put a 50 pip stop loss on something like that, you're going to get stopped out. And if you try it again, you're going to get stopped out again. So it can be a frustrating situation. So, for example, and this is a really good example of what I just described, these are some of the things that we have to keep in mind as we're trading. We need to be talking to ourselves. We need to be analyzing the trade. We need to be managing the trade. I took a trade here, and I have a trade called a continuation trade. And it puts me in the path of a big breakout of consolidation. Oftentimes, if it's in the right, used at the right place, the right location, everything's optimum for the trade, it will put me in the path of a big trending day. Normally, this pair, using this particular type of strategy, the way I trade it, would result in anywhere from 100 to perhaps 150 pips on this particular pair on these time frames. So I had a short signal, and the next candle gave me, or the next two candles gave me an entry. This is a 1 hour chart. So price did not hit its first target. It just hit about 22 and bounced. So we have to manage the trade. Just the same, we have to manage when we see a retracement. So every time I get into a trade, I expect a retracement. I just mentally prepare myself for that fact. But I also have to remember that just because I use about 100 pip stop loss, and I'm using a 100 pip target on this trade, doesn't mean it's going to be fulfilled. It doesn't mean that the target's going to be hit 100 pips right on the number, or that the retracement is going to stop less than 100 pips. There's always that possibility that we can see retests that are deeper than what we expect. So we have to identify support and resistance. So from the point in time where I got into my trade, I needed to identify the resistance level. So here's what happened next. After the entry, of course, it didn't hit its first target, but it retraced. And it retraced deeper than what I was expecting. But I needed to understand that here was overall resistance that created the entry or created the trade to begin with. I'm not saying that every single time we have to use support and resistance, but we have to be aware of support and resistance overall. Because from a visual point of view, every trader is going to easily and quickly identify that as the high. If they get into the trade after you get into the trade, that's what they're looking at. That's what they're going to identify as a safety zone or as a safety level. They want to see how price acts if it nears resistance if they're shorting, and just the same, the opposite direction. Just the same, but the opposite if you're trading back up. So this retracement went a little bit deeper than I expected, but I needed to be conscious of what was happening. I couldn't let my fear or my anger or my confusion or my frustration get the best of me. You can't do that. You need to be aware of what's actually happening in price, not what you want to see happen. We have to be aware of what's actually happening. So do some technical analysis as you see a retracement when you're in a trade. Notice old support, if price is actually holding at old support, or if it's moving a little bit through it. And if it's moving a little bit through it, go to a smaller time frame and identify a significant price swing, which this one was, and see how far the retracement is. Here it went to the 618, and here's the 20-day moving average, which I also use every day. So there was a lot of information here that showed that there was the possibility of some additional resistance, just a retracement, nothing to panic, nothing to worry about. And then ultimately we see after the retracement, price went all the way down and fulfilled all the profit targets that I was looking for, and I was able to trail it much further than the final target of 110.50. So just remember, you have to allow for a certain degree of flexibility, but don't change or scrap your entire trading strategy. Without that trading strategy, you have nothing to compare the good trades and the bad trades to.